Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. Really an intense market environment out there in the wake of what we saw this weekend.
Absolutely. People are shifting away from wait and see and perhaps drawing conclusions that this may go on longer.
Absolutely. Well, let's get to the biggest stories right now. In the nearly $21 trillion global ETF industry, oil topping $100 per barrel as the war with Iran rattles markets, spurring losses in both stocks and bonds.
So in a few minutes, we're going to dig deeper into how to position against this geopolitical uncertainty with Bruce Bond, CEO and co-founder of Innovator ETFs.
And we'll also speak to Joel Shulman of Entrepreneurshares about his fund's surging stake in SpaceX, raising doubts over private assets in ETFs. All that and more coming up. But as always, Eric Balchunas from Bloomberg Intelligence. He's here with us now, and he's looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you. The flows are finally looking a little nervous. We've had, again, it's been a flowathon, really, for the first 2 months of the year. $10 billion a day into ETFs. Well, that has stopped, right? The last couple of weeks have been a little bit of a downturn, but this last week, pretty bad. If you have SGov leading, that's not good. That's a Treasury ETF. This is also a cash ETF. VTI and VU, I mean, you'd probably need nuclear war to stop Vanguard investors from investing. But if they're on the leaderboard again, that's normal, but still, you don't see any of the trading crowd ETFs up here. And IGV, interesting. This is the software ETF. We had written a note about how some of the AI names in there are actually not that vulnerable. Interesting to see people playing the dip there on that one. Let's look at the outflows, and you will see the trading crowd favorites here. So that's a massive amount of money, $11 billion out of SPY, and then IVV, which is using models. So you have a lot of money coming from the pro crowd out here. And the Qs. So this is a lot of pros rotating out of equities. Gold, interesting. I think that's just, it's been up so much, people are taking profits because this is a perfect time for gold. And then IWM, again, small caps can't get going, whether it's good or bad, it seems like, even with the outperformance recently. But let's look at this idea of this bifurcation between the trading crowd and the buy and hold crowd, which, again, we see every time there's like this sort of really crisis in this sort of news cycle. So here's a look at the ETFs used by traders. That would be this line here, this color. And ETFs used by the buy and hold investors like Vanguard and Schwab. You can see they always invest. So the past 4 weeks, the Vanguardians have done what they always do. They are not shaken. They are going to continue to invest till otherwise notified. And then here are the traders, though. That's 5 straight weeks of outflows, including the worst week here with $20 billion. So that's some risk off being seen right there, Katie, at least amongst the traders who are more easily spooked than the Vanguardians.
Absolutely, Eric. Thank you. Let's keep this conversation going with Bruce Bond. He is CEO and co-founder over at Innovator. Bruce, it's great to see you.
It's great to be here. Thank you.
And of course, Innovator bought by Goldman Sachs late last year, which we're going to get into. But I want to start with the market action that we're seeing and where the flows are going into this market. Innovator, a pioneer when it comes to buffer ETFs, which, as the name suggests, you give up some upside in exchange for downside protection here. So I'm wondering what this moment means for buffered ETFs, something that I know that you've positioned as sort of bond replacements.
Yes, well, many people, I think that when you buy the S&P 500, they are somewhat comfortable with they're going to get the upside, they're going to get the downside. But people in the past haven't had access to something that they can get most of the upside, but they don't have to take the downside. That's what the buffers do for you. You buffer it out for the loss for the first 9 or 15%, and you get a certain amount of the upside from that. And investors historically have just had to ride along with the market. Well, they really don't have to do that anymore. You can participate over a year, over a quarter, and allow people to really participate in the upside of the market without the risk of the downside of the market. And that's what people love about these particular products.
So Katie mentioned the buffer ETFs as a bond replacement. You've made the case that buffers can be better than bonds.
Yes.
Right now, bonds aren't really doing their job. You look at what's happening today, for instance. Bond prices are falling, yields are rising. Make the case for why buffer ETFs can do what bonds currently can't.
Well, I mean, if you think about it, bonds are down, stocks are down. I mean, aren't bonds supposed to go up when stocks go down? Well, they are supposed to. And you know what? The story we've been told for so long is that they're going to have negative correlation with one another. And you know what? Over the past, 10, 15 years, when there's a big challenge in the market or spike down in the equity market, bonds tend to go right down with it. So people aren't buying that much anymore. That's the reason the 60-40 is struggling. The beauty of a buffer ETF is you can know your outcome. You can know I have 10% downside protection and I have this much of the upside, or I have 15% down. And so there's this guesswork, this negative correlation, these ideas that you think you need in the market that break sometimes when the market really gets broken. You don't have to worry about those. And people that are investing in the market, they would rather have the bumpers up, most of them. If you're pre-retirement or in retirement, you want to have the bumpers up. Typically, you don't want to risk losing all that money.
And I have to say that buffer ETFs, they do have their detractors. Last year, actually, we spoke with AQR's Dan Villalon, who said that buffers ETFs are a failure. Let's take a quick listen.
I would say, if you kind of step back, the reason they're a failure, the reason we said that, was because we found the vast majority of investors would have been better off just having less equities in their portfolio from the start. And when I say better off, I mean both in terms of higher returns over time and mitigated drawdowns. So that's why they kind of miss on both counts.
Yeah, I see this a lot on social media. There was a big debate. AQR brought it up. There's been some other quants who are like, well, you really just should do this, even a little bit of cash and the equities long term would do the same thing with less fees. What do you say in response to these objections?
What I would say is that in that situation, cash is a total drag. You don't get any return from cash. Yes, it will reduce your risk, obviously. I mean, if you want to reduce your risk completely, go all to cash, But that makes no sense. AQR's performance, if you look at the returns of their funds, have been pretty mediocre. To me, there's a lot of sour grapes going on with that. And I think really buffers are showing people another way to do it. Think about annuities. Or think about market-linked CDs. Why do people do that? People do that because they want security. That's the reason they do that. And to say, well, that makes no sense. If you really wanted the best return, you just buy the Qs or buy the SPY and just let it run, right? Of course. But there's also a lot of risk involved in that. If you're pre-retirement or retirement, you don't want that kind of risk in your market. And there's people that just don't want to risk their assets. This is a great product for them.
This is a good point because we have a theme we were working on last year in particular about buffers killing the low vol star. Low volatility ETFs were a big deal. They've come back, but nobody wants them because you may get some hedging there. With these, it's guaranteed. That psychological effect, I think, is huge. It's interesting your take about maybe eating into alternatives as well. I want to ask you, though, about the issue of the laddering of buffers. There's laddered buffers because sometimes people don't want to have to remember to get the new one and then sold the old one, get the new one.
Yeah.
Do you think the laddered ones are going to ultimately be the ones that take in most of the money?
There's a potential, but I kind of doubt it, to be honest with you. Remember, with a laddered buffer, you lose your defined outcome. So you don't really know what your outcome would be. So as people get more sophisticated, they may get into the ladders, but in time they're going to look at those and say, hey, I want a more definable outcome. I want more control over my outcome. And so I think people will actually use those maybe as an entrance drug in a sense, but then they'll move over to the buffers. And Eric, the other one that I think is really going to be very popular in the future is the quarterly buffers. They track the market much more closely. And so I think people are very comfortable with those, where they hedge the downside, give you some of the upside, and like BALT, for example, which is for bond alternative. Scarlett, to your point, we do think, think about if you want a low-risk asset in the market today, where do you go? You go to bonds, right? And so what we're saying now is there's something linked to the equity market that gives you safe returns or hedged returns. People haven't had that available to them in the past, and people should definitely be taking a look and understanding these better and what they can do for them in their portfolio.
As Katie mentioned earlier, Innovator Capital is being acquired by Goldman Sachs. That deal should close sometime in the second quarter. You've been remarkable in that you've been able to see around corners. You saw smart beta ahead of time before it became a big thing. You clearly saw buffer ahead of time as well. I guess the question is, what do you see now coming up? Well, what is something that intrigues you in terms of an investing idea, an investing theme?
Yeah, well, I think that for now, what I believe is going to happen is you're going to see these more definable outcomes come on the market. You know, Innovator, what we did was just kind of open the door, but I think there's an amazing amount of value-added investments that can be put through an ETF. We love ETFs. Anything you can put in an ETF, we're trying to do. And we think that this category is going to continue to expand for the foreseeable future. I mean, this is how a lot of the sophisticated money has invested for a very long time. Most people haven't had access to that. Now, in an ETF, on a tax-deferred basis, you can now invest the way some of the most sophisticated money in the market invests.
I'm surprised you're even here. I mean, I would be on a small island somewhere fishing and golfing all day.
Well, thank you. Yeah. As I said, I came in for you, Eric. You know.
I appreciate that.
Yeah.
But are you going to be like a Goldman employee effectively for a while?
Well, yes, I will be a Goldman employee for a while, and just helping them, you know, advising them, helping them achieve the things that they want to achieve at Goldman. We're very excited about this relationship with Goldman Sachs. We think they're the ideal candidate for our firm and acquirer for us, and so we're very, very excited about this relationship.
Well, you are on a small island, that is Manhattan, and it's 60 degrees outside,
Yeah.
which feels tropical relative to what we've been living through. Bruce, it's great to see you. That is Bruce Bond. He is CEO of Innovator. Now, coming up, we'll speak to Andrea Acimovic of Elston Consulting on the firm's focus on copper, oil, and gold, also known as the COG trade. That's next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with Turkish stock ETFs. Take a look at that outflow. You can see that traders really offloading these products by the most in 7 years. We know that there's a lot of unrest in the Middle East right now, a lot of concerns about spillover potentially filtering through these products. But let's continue that conversation, talk about what we're seeing when it comes to fixed income, specifically when it comes to high yield ETFs. You're taking a look at HYG here, really dropping to its lowest level in about 9 months or so. We know that fixed income has been coming under pressure, along with, feels like, everything else. But speaking of that, let's talk about copper, oil, and gold, known as the COG trade. A really interesting chart here. You're taking a look over the past 2 weeks when we've seen this action unfold. You can see that copper down a little bit, gold actually being sold, but what is doing well is Brent oil, up almost 40% over the past 2 weeks, Scarlett, and that explains a lot of the cross asset action that we're seeing.
Absolutely. Katie, let's talk more about this with Andrea Acimovic. She is portfolio strategist at Elston Consulting and joins us now to talk about the COG trade, copper, oil, and gold. Let's start with the C in COG, because I guess when it comes to copper, it's so cyclical and it's tied to people's perceptions of the economy. What's the story, the story to invest in copper that's separate from how the economy goes?
First of all, thank you for having me. From what we do is we try to ensure that portfolios are resilient in changing market conditions and in different market regimes. So basically why we're using copper, oil, and gold is because the current three big trends in the market are AI, geopolitics, and basically the debasement trade. So when it comes to copper, because copper is the metal of build out, it has been key to the renewables theme,
Yes.
Historically, but I think with the AI trend now, we are seeing it makes that bigger because CapEx behind data centers, behind chips, power networks, and related electronics is huge. So to me, copper is really an expression of structural CapEx and an AI build out. And that's why we see it as a structural holding within the portfolios. It's a long-term holding.
Yeah, and it's really interesting. I mean, when you're talking about the AI build out, that was the dominant theme up until about 2 weeks ago. And it'll definitely come back in terms of being front and center for the market. But let's talk a little bit about gold. I find it really interesting that gold is actually being sold right now. It's one of those assets that you would expect traders and investors would be reaching to in times of turmoil. That's unwinding a little bit over the past 2 weeks. I mean, what do you see going on there?
So gold is also our long-term holding. We have always had gold within our portfolios. We just topped it up last year towards mid of the year, and obviously it reached its all-time high at the time. So it's had really a big rally. But gold is, for us, its job is to hold value, obviously, when confidence in the financial system starts to shake. And whether it is concern about the debasement of the fiat currency or policy credibility or the scale of government debt and the rising term premia, you own gold because it's one of the few assets that doesn't rely on somebody else's balance sheet. So, or a promise to pay. So yes, it is part of the debasement trade, but it also works when the bond hedge is less reliable, and that's why we hold gold. Obviously, it is a volatile asset, but it's expected.
By the way, good job with the acronyms. Wall Street likes acronyms. We're going to see if we can get COGS trending here, okay? The COG trade. It should be an ETF, and the ticker, I think, is open. But one thing about these commodity ETFs that I've found over the years is, like, if you're an investor and everything's going up, like your stocks and bonds are doing well, these can be a drag, right? These can kind of, like, the roll costs, and sometimes they don't do well. Right now, you're happy you own them, but I appreciate you being an advisor also. Is it easy to get investors to buy into these ETFs and even hold on to them during, say, the good times?
Yes, so obviously alternatives form a really important part of our portfolios, and we saw that the most in 2022 when there was the inflation shock. We sold off all the bonds and we just kept alternatives. And obviously it sounds like a big risk to take when speaking to clients, but it played out really well. So our clients are always really happy with our calls. And when it comes to gold, we like physical gold. We don't like miners because we believe that when it comes to gold, you want to hold the metal. You don't want to hold the boardroom. And miners...
I like that.
It's a good phrase, yeah.
Yeah, because when it comes to miners, you don't want the operating leverage, and you don't want the governance considerations that come with them. And another thing is that they are higher beta than physical gold, both on the way up and on the way down. So physical gives us what we want, the metal itself.
All right, good stuff. Andrea Acimovic of Elston Consulting, thank you so much. We're going to see if COG can become a thing.
COG.
Copper, oil,
the COG
and
trade.
gold. That's right. All right, we do have some headlines here. The president mentioning that he is considering export curbs and tax waivers to curb oil prices. Excuse me. Again, we're looking at prices in commodities move quite a bit here. Oil prices actually continue to move north right now, but they have pared some of their big advances, and equities have actually given up a lot of their earlier losses and are now paring their declines. From New York, this is Bloomberg.
I'm Nora Melinda. Let's take a look at your midday movers. First up, oil is continuing its surge. After oil surge overnight, it has lessened some of its gains. Brent crude oil earlier soaring, with Saudi Arabia, the world's largest oil exporter, starting to reduce oil production. The move follows the UAE, Kuwait, and Iraq. Investors are becoming concerned that a sustained increase in energy prices will feed inflation and further cloud the Fed's interest rate outlook. Meanwhile, U.S. mining stocks like Newmont and Barrick Mining are falling. That's as investors consider whether rising tensions in the Middle East will reduce demand for precious metals, increase interest rates, and prompt a strong U.S. dollar. And finally, U.S. airlines are continuing their decline as shares of United, Delta, and American Airlines remain lower as spikes in oil prices draw concern from traders. Those are your midday movers. I'm Nora Melinda.
All right, it's time to take a look at the Bloomberg Intelligence traffic light system, which ranks ETFs by risk levels. Green light means low risk, yellow light means moderate risk, and red light means high risk. Eric Balchunas here has one of those for us, USO. And USO, of course, the ETF that tracks oil prices. By the way, volume is out of control today. It's up 473% from the 10-day average.
This ETF is a wolf in sheep's clothing. Ooh. And this is the reason we invented the traffic light system, Scarlett, because this looks innocent. Ooh, the United States Oil Fund. Sounds good. I would get texts from my ex-college roommate saying, I want to buy USO. It sounds like a good deal in oil. What you don't see underneath is the futures you have to roll. And when the times are normal, that could cost you 20, 30% a year. So imagine this thing had an expense ratio of 30%. Like, who would buy it? That said, when oil is in play, like now, it has the most sensitivity of anything kind of trading on an exchange that's been equitized. And that's why people like it in the short term. So I would say, be careful. Use it like a hot potato. Trade it, but then get out of Dodge and maybe go to one of the equity ETFs like XLE if you want to go long term.
This is interesting because this ETF in particular has a bit of a checkered history. I'm not sure what you want to call it, but you think back to, April 2020 when oil prices went negative briefly. I mean, this ETF had to take a series of steps. Now you're almost in the opposite situation. Yeah, this thing, remember when futures went negative or they were about to, and this ETF was going to have to owe people money. So it had said, okay, we can't hold the front month. We have to hold all 12 months. That way it wouldn't be as sensitive to the front month. So it did that almost like the way a turtle would go into a shell. It protected itself for like a couple months there, and then it went back.
Wait, why did it go back, though?
It went back because at the end of the day, the trading crowd who uses this thing, they want the sensitivity. Because there is one called UNL that holds all 12 months. It's barely up. Like, you want that juice, right? And so if you are after the juice, you got to go front second month. You can't do the whole curve or it doesn't move as much. So it was smart to go back, and that's why it's seeing like ungodly volume today. If it had stuck to 12 months, nobody would care about this thing right now.
And it plays out because oil prices, at least oil futures, the front month are surging, whereas the ones a couple months down the road, 7, 8 months, are still in the 70s.
Yeah, I mean, it's in backwardation, right? So you actually get paid to roll, but I would look at that as like a full moon. Like, it doesn't happen very often. You know, you should be thankful when it does. Just assume that these futures rolling ETFs are going to cost you money if you go in medium or long term. In fact, anything that rolls futures, instant red light in our system.
I have a question that I should know the answer to, but you have physical gold ETFs. Do you have physical oil ETFs, or is that impossible?
You can't do it because oil, storing it would be a pain, and it's toxic. Basically, think about this. Anything that you would try to do yourself, like you buy S&P 500 stocks, it's not that hard. So it shouldn't cost you that much, and you should demand excellence from your ETF. But think about oil. Try storing this in your backyard. The fumes alone would be, they would kill you, honestly. So you're going to have to pay and deal with friction and imperfections, and that's sort of the deal here. So that's why there's contango, is no one wants to take delivery of oil barrels. That's why it goes up, the curve goes down at the end, because people will have to pay more in the next month. So it's called storage costs being baked in.
All right, Eric, great stuff. You can take a look at the traffic light system on your terminal at BI ETF Go. Coming up, we're going to drill down into women-focused companies with the CIO and founder of Hypatia Capital next. This is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And it's time for today's drill down, where we focus on one ETF. Eric, what do you got?
Today, we have a very thematically timed ETF, WCEO, the Hypatia Women CEO ETF. If you haven't guessed, it's pretty clear. It holds stocks that are run by a female CEO. We'll go into the holdings in a second. Just want to go over here. The assets are $7.81 million, came out about 2 years ago. Let's look at the cross-section of the holdings. This is interesting to me because when you look at stocks run by female CEOs, what you end up getting is you actually tilt a little bit towards more value-oriented stocks. You'd be surprised. A lot of the tech names, like the Mag 7, run by men, so you're going to have not any of those in here. So you definitely get a little more of a value weighting here in terms of these are the industries that you're going to get here in this ETF. Interesting aerospace and defense in there as well. Let's look at the performance of this ETF. It's a thematic ETF, so you're going to have to compare it against the market. I also put SHE in here. That's that State Street one that everybody knows. And you look, it's underperforming, so it'll have to get better if it wants to get assets, I think. However, it is doing really well this year, again, because it's less focused on those Mag 7 heavy tech stocks, Scarlett. So that's the deal with WCEO.
All right, Eric, thank you. Joining us to talk about this ETF is Patricia Lizarraga. She is portfolio manager and founder over at Hypatia Capital. Patricia, great to see you.
Thanks for having me, Katie.
So WCEO, I take a look at your holdings. I want to talk about the sheer number here. This ETF holds 157 or so names. How has that number changed over the past couple years? Have you seen more companies actually come out and appoint female CEOs?
So the number hovers around 157 now. I think we started a little bit under that, but the number doesn't change much over the last 3 years. So we've been, the ETF has been live.
This is an actively managed fund. What are the parameters that you're using to determine whether you're going to include them in the fund or not? Is it as simple as a company needs to have a female CEO, or are there other things that you're using to assess that?
No, we include all American public companies that have a female CEO with a market cap above $500 million, except for SPACs, which we wait 2 years to put in the fund. The way we deliver the female factor is by adding our proprietary methodology, which is to, first of all, equal weight stocks. And we may underperform the S&P 500, but we outperform the S&P 600, which is our benchmark. So we outperform our benchmark since inception. You cannot compare women to men by size because you actually don't have a woman CEO until you get to company number 29 in the S&P 500. And that would be Lisa Su with the $310 billion market cap. So if you want to actually say if women or men outperform, you have to compare apples to apples. But that's not the only way the methodology works. There's a second factor, which is the industry factor. As you can imagine, there's more women in healthcare and consumer than there are in technology or energy. So in order for us to be comparing apples to apples, we have to eliminate size as a factor, and we have to eliminate industry as a factor. And our methodology does both. That's why it's so active, and we rebalance every month. And if you do that comparison, the closest comparison is the S&P 600. It's not perfect, but it's as close as you can get according to Morningstar and other people who have advised us. So when you look at it that way, we can say we outperform our benchmark.
It is interesting. You know, she would be considered, the other ETF I showed, an ESG ETF. ESG is real overweight tech, but you aren't, obviously. Do you get confused with the ESG movement? Do people confuse this fund with that? Because it sounds like what you're saying is, I don't really care about feeling good. We're trying to outperform here, and we think we have an alpha strategy. Is that what I'm gathering? But does it get confused and wrapped up in the ESG thing, which has kind of been soured a little bit lately?
Actually, sometimes people do ask us that, but you said yourself at the beginning, we own all stocks. We have a lot of fossil fuel in there. We have Occidental, we have Marathon, and we also have defense, right? We have Northrop Grumman, we have General Dynamics, and so we're not an ESG stock, and we don't consider ourselves an ESG stock. Nevertheless, according to Sustainalytics, we have 5 global sustainability globes, which is how you're measured, and that puts us in the most sustainable companies. But in general, we want to be seen for our performance, which is the S&P 600. She benchmarks to the S&P 500 because it's a large cap. We are not benchmarking to that.
And Patricia, I want to zoom out a little bit and talk about, why this ETF exists. Because, I mean, it feels like you have an ETF for everything, every stripe you could consider at this point. But, what you've said, this ETF has been live for 3 years at this point. Put yourself in your shoes 3 years ago. What was the sort of founding logic when it came to designing and creating this ETF?
So our investment thesis is that women CEOs will outperform. Why? It's harder for them to get to the top, right? So the ones that do, by definition, have to be better than average, and the average, by definition, is male. So if you can deliver that female factor, you should get alpha. That was our investment thesis, and actually, comparing apples to apples, we have delivered that. Why is it important for people to understand this? Because it is our point of view that if women have outperformance, we need more women CEOs. And there's less than 10% women CEOs. So how do we get more? By showing that they perform. And as far as we know, we're the only people in the world that are delivering this performance of female CEOs. And our hope is that nominating and governance committees and boards start internalizing this information that actually women are incredible performers, less risky, and put more of them on short lists, and that we have a little bit better balance. That's why we think this ETF is important, in addition to our investment thesis, which past performance is no indication of future performance.
All right, Patricia, we really appreciate you taking the time for us. That is Patricia Lizarraga of Hypatia Capital. And you can read about this drill down, plus the latest in the ETF industry, when you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/ETF IQ newsletter. But coming up next on ETF IQ, the television show, we're going to speak with Entrepreneurshares founder and CIO Joel Shulman, as his fund's stake in SpaceX has sparked headlines as of late. But before we go to commercial, let's take a quick look at markets here, because the NASDAQ 100 actually poking into the green right now. You can see it's racing quite a meaningful drop, about 0.2% higher. The S&P 500 not quite there, but a similar direction. This is ETF IQ on Bloomberg.
Through the trading day in New York. I'm Norma Linda. Let's take a look at your midday movers. First up, oil is paring its gains from over the weekend, coming down from a high of nearly $120 a barrel. As oil continues to pare its advance, the market is responding, most notably with the NASDAQ turning positive. In individual stock news, Live Nation shares are climbing after the company and its subsidiary, Ticketmaster, reached a settlement on their antitrust case with the DOJ. However, New York Attorney General Letitia James said that in a statement, at least 25 states and the District of Columbia will continue with the antitrust trial. She says the settlement fails to address the monopoly at the center of the case. And she said, quote, "We cannot agree to it." And finally, shares of Hims & Hers Health are soaring for their best day on record. That's after Novo Nordisk agreed to sell its obesity drugs, including Ozempic and Wegovy, on Hims' platform. As a result, Hims will no longer advertise its copies of Novo's medications and will only sell compounded versions of Wegovy and Ozempic if a doctor deems them necessary for a patient. Those are your midday movers. I'm Norma Linda.
Now let's get to the ETF life cycle, where we walk you through the three main stages of ETFs, from initial filings to final farewells. Step one is the filing. Direction has submitted paperwork for a pair of leveraged single stock ETFs on a company that's not even publicly traded, Anthropic. Direction has registered for a 2x bull ETF and 2x bear ETF on the company. Step two is the launch. The Roundhill Space and Technology ETF is now trading under the ticker MARS. The fund is actively managed and offers exposure to the space economy and enabling technologies, focusing on companies that power industries reliant on space infrastructure, such as GPS, internet, and weather forecasting. And for some, the final stage is farewell. Invesco shutting down a bunch of ETFs, a pair of ESG funds, a minimum volatility fund, and a blockchain decentralized commerce fund. And that is your life cycle.
Thank you for that, Scarlett. Yeah, really interesting. We were just talking about ESG, and now you're seeing Invesco shutter a pair of them. But let's talk a little bit about another ETF that we've been tracking, and that is the Shares Private Public Crossover ETF, ticker XOVR. Now, currently, around 37% of that ETF is invested in Elon Musk's SpaceX. That figure has climbed well above 40% in recent days, according to data compiled by Bloomberg. Let's talk to Joel Shulman. He is the founder and CIO of Entrepreneurshares, which built that fund. He joins us now in person. Joel, it's great to see you.
Nice to meet you as well.
So there's a lot to get into here. I want to talk about performance first off, because you take a look at XOVR over the past year or so. It's higher by about 6%. That is trailing its index, trailing the NASDAQ 100 as well. And there's the question out there percolating in the markets, you know, given that SpaceX's valuation has increased several times during that 1 year period, why hasn't that translated necessarily into XOVR's performance?
Right. Oh, thank you for asking that question. It's very important to have perspective on the period. And as you know, because you track ETFs all the time, any sort of performance period has to look at the full picture. So first we begin with 85% of our portfolio performance is driven by the ER30 Total Return Index, which has a 20-year track record. And in that 20 years, we'll see that it spiked well above the Qs in 2020. It came down, and then it spiked again in 2024, and October 27th it peaked. So in this performance period that others are criticizing about, there's essentially five distinct periods of that one year track that they're looking at. So for example, if you go back to August 29th, 24, when we launched, from there to February 14th, 25, we were up 27%, well above the benchmarks. The comparison periods come in towards the tail end of that, so they're missing out in the first part, which is the dominant part of our portfolio. We went down from Feb 14th to April 8th, that period when the market fell down because of the tariffs. We moved about 20 to 25% down. The markets moved. These benchmarks also moved about 20% or so. Then from April 8th to the third period, April 8th to October 27th, we went up 50% on our ETF, 60% on the index. The index doesn't have the fees and the performance cash drag, but 50% clearly dominating our benchmarks by a wide margin, over 1,000, over 10%, 10 to 15%. And then the key period is October 27th to Feb 23rd of 26. October 27th to Feb 23, 2026. We fell, this is the distinctive period where we fell quite a bit relative to our benchmarks, and it was primarily related to fintech that we had, and we're underweight the mega caps compared to our benchmarks, and that was it. And then since Feb 23rd, we're up another 4% relative to the benchmarks. But yeah,
this was the guinea pig fund for privates, right? Since then, Ron B has added the actual shares of SpaceX. You did it via SPV.
Correct.
It went in, people bought into the fund.
Correct.
And the weighting of SpaceX went down because you can't go get new SpaceX. So two questions for you. The two concerns we have are, what is an SPV? What are the costs associated? And what about this idea that, okay, fine, you're the SpaceX fund, you get all these people to come in, and then the people who come in towards the end only get 3% SpaceX. Why don't you get more? How's that work? I think those are the issues.
By the way, fair question. Glad you asked. By the way, it was your post that notified people, look at all the AUM, and it's got less than 2%. So we went from 400 million or so to 1.8 billion dollars in about 8 trading days. These were 8 trades. What a lot of people don't know, they think it's a run on the bank, like 1930s run on the bank. It was basically 7 to 10 trades, large trades, maybe arbitrageurs. We don't know who's coming in. It's an ETF. They come in and they disappear very quickly. So what happened was when the AUM spiked to 1.8 billion, our percentage weight now in SpaceX was less than 2%, which has almost no impact on the performance. It's driven by the 85% or more of our regular public holdings. And so what happened was we have to go back and get it. And I'm going to talk about SPVs in detail in a moment. We were in a structure that was not as efficient. We were the pioneers. We were the pioneers in this. And so we're trying to establish things in the most efficient, effective manner possible. So we were in SPVs. It wasn't as efficient as we wanted to be, so we shifted our structure to something that would be more transparent. Ironically, a lot of the controversy, which is still being confused by some other reporters, not Bloomberg, by the way, you guys got it right the other day, but other reporters and other high-profile journalists got it wrong. You know, we had to pay up one-time expense to get more SpaceX. So, for example, when we're 2% weight or less in an exposure that people want to have, we have to go get it. It's not like going to Walmart or CVS and saying, I want a bottle of water. It takes a lot of time to negotiate these transactions. So we, wanted to move to an efficient structure.
Right.
Okay, 2, we wanted to move to something that's going to be transparent to shareholders going forward because we didn't have that previously. And 3, the key part of all of this is when the dilution came in and AUM spiked, and other people, by the way, got this wrong, not you guys, other journalists got this wrong. They drew the graph, but they didn't interpret the graph properly. When the AUM spikes, the dilution effect comes down, and then to go back up to get the percentage, that's the key point. When you have to go back up, we're coming back to get SpaceX exposure at precisely the time that everyone's talking about potential IPOs and everything else, and so the price goes up. The demand was sky high, which was the AUM, and the supply was down because what shareholders, whether you're an employee or whether you're an institutional investor, what shareholder wants to get rid of it at that point? And we're trying to get it into, and I'm going to get into the details of the SPV, what is effectively a 0-0.
Well, Joel, we only have about 2 minutes left.
Okay,
Let's talk about the weighting a little bit, because as
Yeah.
I said, 37% right now. The
Correct.
SEC has a cap
Correct.
on the liquid assets and open-ended funds
Yeah.
of 15%.
Correct.
You are well above it. So
Correct.
what is the plan here? Do you plan
Okay.
to sell down
No.
the SPV?
No. So we have a plan. We've communicated with all the proper authorities and our board. Everyone's on the plan. We're exercising the plan. We're executing the plan. It's 37%. We actually have about 13 million of cash in there, so it's technically 35%. But importantly, we're executing this plan. We don't plan to sell based on the plan. What was very important to know.
But what is the plan, though?
It's a plan that I'm discussing with the board and our the regulators, the appropriate parties. The plan is not to sell SpaceX. We have a good exposure. We have a strong conviction in this. What's important for investors to know is that we have a strong conviction in this security, this exposure, not security, exposure. We believe very strongly that if the rumors are true with the IPO, we believe that this is a good position to have for shareholders, particularly in this market, and we're executing that plan. So I think for shareholders to know, it's a strong position. We have conviction in that position, and our plan currently is to maintain that position.
All right, Joel, we got to leave it there. Thank you so much, and come back when you are able to say more about the plan once it's all cleared.
100% would be delighted to do it. Thank you.
Joel Shulman of Entrepreneurshares with that stake in SpaceX through an SPV. Coming up on ETF IQ, it is time for an IQ test where Joel Weber puts our ETF knowledge to the test. I think if we had a leaderboard, Eric is probably in the running, or maybe it's Katie. Here's a sneak peek of one of the questions. About 140 crypto-focused ETFs already trade in the U.S. How many additional applications are pending at the SEC, according to Bloomberg data?
Ooh, that's a hard one.
50 to 100, or 200 to 250, or somewhere in between. This is the ETF IQ.
Now it's time for an IQ test where Bloomberg's Joel Weber is going to see whether Scarlett, Eric, and I really know our stuff when it comes to ETFs. Joel co-hosts the Trillions podcast with Eric. He's also the head of games at Bloomberg. Joel, put us to the test.
You know your stuff, but we'll see if you know these answers. Okay, we have 3 questions for you. The first question: the Breakwave tanker shipping ETF, ticker BWET, tracks the future cost of shipping what?
Ooh.
This is a top-performing ETF of late. Is it A, fertilizer, B, LNG, C, crude oil, or D, bananas?
Who wants to go first?
I know it's not D.
Okay, so we
Probably
go
go in this order. I think you should go first.
I really
roll
want
that D.
it to be bananas.
Yeah.
I know it has to be between LNG or crude oil, so I'm just going to say LNG.
Okay,
I'm going to go for crude oil.
okay.
I'm going to go with crude oil C.
Oh, no.
It is C. Sorry, Katie.
I'm
Off
gonna-
to a rocky
When you
start.
get here.
I'm going to wheel
Down
myself
1.
out of here.
Yeah, all right. Congrats. There it is. Letter C. Question number 2. Are we ready?
Yep.
A new survey of 350 institutional investors by Brown Brothers Harriman found that 99% of respondents would consider doing what? Is it A, launching their own ETF, B, increasing exposure to active ETFs, C, moving away from the traditional 60-40 portfolio, or D, buying private market assets in an ETF wrapper? What do you think, Katie?
I'm going to say D.
Okay.
I'm going to say C.
I know it's D.
Okay.
Oh, thank goodness.
It is D. All right.
I
You're back,
like
you're
it.
back in
You're
it.
in.
Back in
Congrats.
it.
That too.
All right.
Hence the XOVR situation.
All right, and
Exactly.
here is the final question of this week. We had a tease of it earlier. About 140 crypto-focused ETFs already trade in the U.S. How many additional applications are pending at the SEC according to Bloomberg data? Is it A, 50 to 100, B, 100 to 150, C, 150 to 200, or D, 200 to 250?
So apparently James Safer put this in a research note, and I didn't read it. So I'm going to say B.
Okay.
Okay.
I'm going to say C.
It is between B and C. It's around 150, but I think it's going to. I'll go B.
Correct.
It's B?
It's the under.
Yes.
All right.
Yep. 100 to 150. If you like playing quizzes like this, you can go to QuizGo on the terminal or play Bloomberg.com's Pointed at Bloomberg.com/pointed. pointed where you can play with some points and some leverages.
Do ETFs ever make it into pointed?
Of course, we bring them in from time
Right.
to time when necessary, but this is just
Not
for you all.
often enough.
Okay, well, ETFs are the story of
do have
everything.
discretion.
I feel like on this show, you could give you the world and it wouldn't be enough.
That's true. That's very true. Thankfully, we have at least an hour now. But Joel, really appreciate it. That is Bloomberg's head of games, Joel Weber. And that does it for this edition of Bloomberg ETF IQ. I'm Katie Greifeld along with Scarlett Fu and Eric Balchunas. And this is Bloomberg.